Yes. So, after looking at the financial position, at the profit and loss statement, which are the two most important elements of a financial statement, two most important accounts of a financial statement. One of them will tell you the profitability of the or the financial performance of the company for that year, which we call as the statement of profit and loss. And the second shows you the financial position on a particular date, which we call as the balance sheet. Now that we have looked at the revenue, expenses, assets, liabilities, we're going to go ahead to understand who exactly uses these financial statements. Now the users of these financial statements are often called as stakeholders, right? So what exactly is a stakeholder? So a stakeholder is anybody who is affected by the decisions taken by the company. I repeat, a stakeholder is anybody who is going to be affected by the decisions taken by the company, right? So who all could be the stakeholders of the company? Employees, managers, directors, shareholders, customers, suppliers, the public in general, banks which give loans to the company, right? So now what is exactly the interest of each of these stakeholders in the financial statements? Let's look at it one by one. The first one is the managers of the company. These are appointed to look after the day-to-day activities of the business. They need information about the situation to see what is the future of the company. This will enable them to manage the business more efficiently and to plan for the future. Next is, of course, the shareholders of the company. These are stakeholders, or these are investors of the company, or in other words, the owners of the company. Yesterday we saw a concept called as capital or equity providers. Shareholders are the one who provide this capital or equity, right? Now they are interested to see how the company is performing, because as I said, all the profit remaining, net profit, goes to the equity account. So therefore they need to know how much profit the business is owning. Is the business generating enough profit or not? Because out of this profit component, they will get the dividend. Dividend is basically the return to the shareholders. Like we pay interest on the loan that we have taken, dividend is a return that we give to the shareholders. So they are interested to see if they are getting good dividend or not. Perfect. Coming up next is the trade contracts. Now trade contracts could be anybody. It could be the customers, it could be the suppliers. The customers would want the goods at lower prices without affecting on the quality. The supplier would want to get the best possible pricing for the raw material that they supply to the company. So they would want to know if the suppliers give the raw material to the company on credit. That is, if the suppliers give them an option to pay later, they want to know if the company is in a position, do they have enough money to afford to pay later. Otherwise their suppliers will lose their money. So this is what the suppliers want to see through the financial statements. Trade contracts include suppliers who provide goods for the company on credit and customers who purchase the goods or services provided by the company. Suppliers would want to know about the company's ability to pay debts, and customers would want to know whether the company is a secure source of supply and is no longer at a risk to close down. Otherwise, they will have to look at different options to buy their goods and services and to have their needs met, right? So in this way, these two stakeholders want this particular requirement from the financial statements. Going ahead, the providers of finance. Now these are the banks, lenders. Obviously they are going to provide money. They are going to give the money to the company as a loan, and they would want to be ensured. They want to be assured that they will get the money back. So basically from the financial statements, they are going to see whether the company is in an ability to repay the money to them or not, correct? Providers of finance to the company might include a bank which allows the company to operate an overdraft or provides long-term finance by granting a loan. The bank wants to ensure that the company is able to keep up the interest payments and eventually repay the amounts advanced. right? The taxation authorities, that is basically the government authorities. The government is going to impose tax on the companies because this tax that they collect from the companies and all the individuals in the country is going to be the government's revenue that they're going to spend on the public welfare. So the government wants to know whether the company will pay good tax and whether they are prompt in the tax payment, if they have made any default or not, right? The taxation authorities want to know about the business profits in order to assess the tax payable by the company, including the tax on the sale of goods and services, which is called as the sales tax, or in India, the GST, goods and service tax, right? Employees of a company, of course, want to see whether the company is generating enough money, enough revenue in order to pay them good salaries, in order to give them increment for the next year, and whether the company will continue working in the long term. Otherwise, they will have to look for new jobs. So they have a right to information about the company's financial position because their future careers, and as I said, the size and the increase in their wages and salaries depends on the company's financial performance. Okay? I hope you're clear so far with whatever these users intend to search in the financial statements. Next up, the financial analysts and advisors, the portfolio managers, the hedge funds, the mutual funds, etc. Okay, what are they looking for? They're looking for information to give advice to their clients. For example, the stockbrokers, need information to advise the investors. Credit agencies want information to credit agencies basically like credit suisse. They're going to advise banks whether to give this company loan or not, depending upon the company's repayment capacity. Journalists want to know whether the company is into any controversy or any kind of financial trouble, right? One of the example is Kingfisher, like it committed a big fraud, so the journalists would want to uncover that story, and thus they are interested in what the financial statements are looking like. If you want to see a good view a good series related to the financial controversy or a scandal, Scam 1992, which is on Harshad Mehta. Probably many of you have already seen it, but if you have not, it is definitely a recommended watch. Okay? The public in general. Now the public in general could include anybody. So big companies do CSR, which is corporate social responsibility, that is public welfare activities for the community in general, by building roads, bridges, dams, schools, hospitals. So the public wants to know whether the company is earning good profit, sufficient profit, in order to do good CSR and welfare activities. Entities affect members of the public in a variety of ways. For example, they make a significant contribution by providing employment to the people in the local community. Another effect is that some companies may have a heavy impact on the environment, may create pollution, which may be a cause of concern to the people living in that area. For example, it is reported that a stone of Taj Mahal has started to, in the past many years has started to turn yellow and pale because of the pollution in the neighborhood and in the vicinity. So that is a harmful damage committed by companies around and needs to be checked. The public will be very concerned about this. One of the good example is Delhi is a highly industrially developed city. However, the downside of that is the extreme air pollution and noise pollution that the city faces. Okay? So this concludes the users of financial statements. Now, we need to understand what are the structures of business entity. Okay, what are the types of business entities do we have all around us? Now, one of the obvious that we know is companies, right? Along with that, you also can see two other prominent types of entities around us. First one is a sole trader. Where could you possibly have seen a sole trader? Maybe a grocery shop around you as a sole trader, or a CA firm is run by a single CA. Okay, so what exactly is a sole trader? A sole trader is a business run and owned by only one person, perhaps employing one or two assistants and controlling their work. Two things here. In a company, there is owners, who we call as the shareholders, and then there is directors who manage the company. In a sole trader, the ownership and management both is done by one single person. First thing. Second, it's not that he's the only person working in there. This is a common confusion. He may have one or two employees, but they are neither the managers nor the owners. So the entire power of decision making lies only in the hands of this single person. In law, a sole trader is not legally separate from the business that they operate. The owner is legally responsible for the business. The owner is legally responsible for the business. Okay, so what does this mean? If the business goes into a loss and there is still a loan pending of 50,000 and the business is in a loss, so obviously the business money will not be sufficient. In that case, the owner and the business cannot be separated. The owner has to attach his personal property, probably his house, his jewelry, and pay that 50,000 loan. So thus, the business and the owner is not separate in a sole trader. A sole trader must maintain financial records, balance sheet, profit and loss, and produce the financial statements as well, right? The next type of business is partnerships. Now we have partnerships all around us. You may know a CA firm where there are 2 or 3 partners. There could be a law firm where there are a couple of partners. So what exactly is a partnership? A partnership occurs where 2 people come together to run a business. Okay? They generally form a contract. Now in some states in India, registration of partnership is mandatory. For example, in Maharashtra. But in some states, it may not be mandatory. Irrespective of that, when partners come into business, they generally have a partnership agreement. It may be oral, it may be written, but there is a partnership agreement. What all is included in this agreement? How much capital each partner will bring in? How much profit percentage each partner will enjoy? What are the responsibilities of each partner? How much salary they will get? And the process if the partnership has to be dissolved. Like sole trader, partners are also going to keep financial records and produce the balance sheet and P&L. Okay, but however, there is no requirement to make these to the public. Like companies have to make their financial statements available to the public, not just their owners and investors, but to the entire public. For partnership, the financial statements are only for the partners' sake. No need to make them public for everybody. Perfect. I hope we have understood partnership and sole trader. Okay. After partnerships and sole traders, the next entity that we have is the limited liability company, which is an entity that you would have often seen around you. Okay. So limited liability companies are again of 2 types. One, which is a private limited company, which is often owned by family, friends, and then a public limited company. Public limited companies examples are Reliance, Infosys, Tata, Wipro, L&T, etc. Okay, so what exactly is a limited liability company? As I told you, a company is formed when owners or investors or shareholders, all of these terms are synonyms, bring in equity or capital to start the business. When sold, now another important point is that these owners or shareholders have limited liability. What do we mean by limited liability? While sole traders and partnerships the owners have unlimited liability. Same as sole trader, partnerships have unlimited liability. What is the meaning of unlimited liability? As I told you, let's say the partnership goes into a loss. There is a loan of 50,000 left to be unpaid and the business money is not sufficient. Partners have to attach their personal property, their personal home, their personal jewelry they have to sell and thus pay this 50,000 loan. Now shareholders on the other hand have limited liability. What does this mean? They are not responsible for the company's debts unless they have given a personal guarantee. What does this mean? Let's say I am a shareholder of Wipro and I hold 3% of the stake. Tomorrow we have a devastating news that Wipro has committed some sort of fraud, for example, and the company has to be shut down. I am an owner of 3%. Let's say the amount is 15,000. Now I don't have to attach any of my personal property for the loans that Wipro had taken, which they are not able to pay now because the company is shutting down. I am not personally responsible. My personal property will not be attached because I have invested in a company, unlike a sole trader or a partnership. So what exactly is my loss? This 15,000, obviously its market value has gone down to 0. So the shares value has gone down to 0. That is my loss. But my personal property is not attached to pay the loans that are remaining in Wipro, right? Then when is my personal property attached? Only if I give the bank guarantee. That is, if I tell the bank that, look, I trust in this company, I take the responsibility that if Wipro does not fulfill this loan of 50,000, you can take my property. If only there is a personal guarantee, my property will be attached. Otherwise, I am not responsible for the loans that the company has taken, because the company is separate from its shareholders. Correct? However, they may lose the money that they have invested. So as I said, I lose at 15,000 of the share value, not any of my personal property. The shareholders in companies can be individual or can be other companies as well. Limited liability companies are formed under a specific act. In India, the Companies Act. In UK, the Companies Act. The company is separate from its owners. As I said, the company has its own rights and duties. For example, if Reliance is buying some raw material, it will not be in Mr. Ambani's name. It will be in the name of Reliance Corporation, correct? The company can enter into contracts in its own name because it is a separate entity from the shareholders. Another important thing in a company is that the owners and managers are different. The owners, as we have seen, are the shareholders. However, the companies are managed by directors of the company. You might have heard this term directors or board of directors, which consists of CEO, Chief Executive Officer, CFO, Chief Finance Officer, executive directors, so on and so forth, right? So the company's day-to-day affairs are run by the directors of the company, not looked after by the shareholders of the company, right? The shareholders provide capital, and in return, as I said, they get a dividend. Like loan gets installment, interest, shareholders get dividend. And the directors are appointed by the shareholders to run the company on their behalf. I give the example of our government. Like the people elect the politicians to run the government in our name, shareholders appoint the directors to run the company for them, correct? Now, in reality, actually, directors can also be shareholders. So, for example, let's say the Ambanis, they can be shareholders as well as directors. So, director, if he's a shareholder, can have a lot of power in his or her hands, right? I hope this is clear. Next, how do you form a company? Be registered at a company house. You have to form two most important documents, which are the MOA, Memorandum of Association, and Articles of Association, AOA. This consists of the policies, rules, regulations of the companies, the do's and don'ts, the shareholders' names, the capital invested, etc. Have at least one director. He can be a shareholder. There is no compulsion though. Prepare the financial accounts. Have its financial accounts audited if your revenue is above a certain and profit is above a certain limit. Only then you need to audit it, and distribute the financial accounts, make them public. That is, give the amounts. If it is a public limited company, that is Reliance, Infosys, Tata, Mahindra, then you have to publish to everybody. But if it is a private limited company, only to the shareholders of the company. This is the process in which limited liability companies are formed and they function. Now, next up, we have corporate governance. What exactly do I mean by corporate governance? Corporate governance are basically a set of rules and regulations, policies, to show the directors how to run the company. Now, why is corporate governance necessary? Corporate governance is necessary because of frauds like Enron, Satyam that have taken place in the country and across the world. So, because the directors are at the top level of the company, the board of directors, right? The directors enjoy a lot of power. In doing so, the directors in return to their work get salary or get remuneration. But because directors have so much of power, they at times abuse their power or take misadvantage of that power. This can lead to be a big cause of concern for the shareholders and overall for the stakeholders of the company. Thus, to keep the directors in check, in control, it is necessary to give them a set of principles on how to behave and how not to behave, basically like a code of conduct. That is the concept of corporate governance. It's a system by which companies and other entities are directed and controlled. Good corporate governance is important because the owners of the company and the people who manage the company are not always the same, which can lead to a conflict of interest. When the directors start to think for their own selfish reasons, they are threatening the good development of the company overall. The board of directors are usually at the top level and are charged with the governance, the working of the company. Thus, the responsibilities are wide ranging, and corporate governance tries to ensure that the directors think in the best interest of the company and not their own selfish interest. So, let us look at what are the responsibilities of the directors. Okay, first thing, directors have a duty of care to show reasonable competence and may have to indemnify the company against loss caused by their own negligence. So if a company is going into a dangerous position and has incurred a loss because of carelessness of a director, he should be held responsible for it. Directors are also said to be in a fiduciary relation in position with the company, which means that they must act honestly and in the best interest of the company. So as I said, that directors are the entity on whom the shareholders place their trust. They appoint the directors to run the company on their behalf. Okay, so the directors should respect this trust and faith that the shareholders have shown and run the company in the best interest, whatever is best for the company and not whatever is best for their own personal interest. Correct? The 7 statutory duties which are common to directors all across companies are: act within their powers, do not do something which is outside of their power, which is not within the boundaries of their power, promote the success of the company, always put the needs of the company first, exercise independent judgment. Beyond all the data, statistics, there is some gut instinct or judgment call that the directors have to take based on their experience, their knowledge. So take that judgment call. Use your own expertise. Exercise reasonable skill, care and diligence. You're put in a position to run the entire company. Naturally, you should have the skills and knowledge to back it up. Avoid conflict of interest. Don't think about your own interests. Think about the interests of the company. Not accept benefits from third parties. If the third parties are giving you some bribe to make the order in their favor, don't accept it. Always put the company first. And declare interest in a proposed transaction. Let's say the company is ABC company is where you are a director. ABC company is trying to make a trade contract, make a business transaction with XYZ company, right? Now, XYZ company's board of directors has your brother on it, okay? So, you actually have an interest in this deal. You have to come clean. You have to inform all the directors beforehand that, look, I will not be involved in this deal because my brother is on the board of the company or with whom we are trying to make this deal. So, come clean if you have any conflict of interest. Getting? Now, an overriding theme of the Companies Act is the principle that the purpose of legal framework surrounding companies, it should be able to help companies to do the business. A director's main aim should be to create wealth for the shareholders. So directors are appointed by the shareholders to run the company on their behalf. And shareholders want maximum profits, maximum dividends, maximum returns. Naturally, a director's effort should be to maximizing the profit, wealth of the company. Now, when doing so, the director should be mindful of a couple of things. The consequences of the decision in the long term, very important. In the short term, it may be so that the director has taken a decision which will maximize the wealth of shareholders. But if this decision involves using cheaper quality goods or compromising on the quality, then it will not have good impact on the long term. So don't forget about the long term. Don't just think about the short term. The interest of their employees is very important. It might be so that in giving employees very poor wages, you're saving on the cost and thus giving more return to the shareholders. But in doing so, you will lose on the good employees and thus lose on the good future of the company. The need to develop good relations with customers and suppliers. So you can't just focus on the shareholders and profit alone, because if you think too much about the profit, you will increase the selling price, you will compromise and make the customers unhappy. Same with the suppliers if you don't listen to their demands. The impact of the company on the local community. Again, in order to maximize profit, you may choose a land which you're getting at a cheaper rate, and thus will save the cost, make the shareholders happy. But in doing so, let's say you are endangering a species locally, or you're endangering the environment, then that is not an advisable thing to do. The desirability of maintaining high standards of conduct and good reputation. Again, as I said, that it is very important to not fall prey to the short-term greed, short-term profit making, but always focus on the long-term sustainability and long-term profit, right? And to act fairly to all the members of the company. Not just think about the shareholders, but also think about the employees, customers, suppliers, community, environment, etc. Right? So all of these constitute the responsibility, legal responsibility of the directors of the company, right? I hope everybody is with me on this, okay? So in this way, we have understood that what are sole traders, we have understood what are partnerships, we have understood what are limited liability companies, also covered what are the legal responsibility of the directors. Perfect. And also one more important concept, how to keep the directors on track and corporate governance, right? Okay. Now, the next part is who exactly is responsible for the financial statements. Now, financial statements, that is the profit and loss, balance sheet, etc., are made by the accountants, finalized by the chartered accountant or the ACCA in the company. But who exactly is responsible if there is any mistake, error, or any fraud, any intentional mistake in the financial statements? Now, the preparation of financial statements has to be done, compulsorily done, with the help of some standards. Now, these standards are known as IFRS, International Financial Reporting Standards, which are what we're going to study from F3. Okay, from this subject itself, expanding in F7 and SBR, right? Now, the internal controls, there should be some kind of controls, some kind of checks that should be present in the company to see that the financial statements are free from errors and frauds. Fraud is when there is a intentional default done by the people in the company to cheat, to steal, to take money for their own advantage. Fraud is intentional and errors are unintentional. Errors are by mistake. For example, if if there's a 500 rupees note lying on the table and near it is your bag, okay, you're going to pick up your bag and by mistake the note is also taken with it, you realize it later and you put it back. That is an error. But if you see a 500 note near your bag and you pick it up, don't tell anybody, that is a fraud. Getting? So therefore, now it is a responsibility of internal controls to see whether there are no frauds or errors. What do we mean by internal controls? Let's assume a bank. A bank has a lot of loose cash, right? So how does the bank protect its cash? There are alert systems, there are CCTVs, there are security guards. These are some examples of internal controls. Similarly, all companies should have internal controls to make sure that there are no errors and frauds. The prevention of errors and frauds is the director's responsibility, and they have to comply with the laws and regulations. So ultimately, if there are any errors or frauds still in the financial statements, the responsibility lies with the directors of the company. They should explain their responsibility for preparing the accounts. They should also report whether it's a going concern with supporting qualifications and assumptions. So to put in other words, the ultimate responsibility of the financial statements being correct, being accurate, that is without having any errors or frauds in them, lies with the directors of the company. The ultimate responsibility of there being no errors and frauds in the financial statements being correct, lies with the directors of the company, right? The directors also have to tell whether the company is a going concern or not. What do we mean by going concern? Going concern is basically to see whether the company is in a position to continue its business in the next 12 months. Let's say the company is on the edge of earning a loss or has made a big default. There are good chances that the company might collapse in the next 12 months. So the director has to do a careful study of it, and he has to give the final verdict, final judgment of whether the company is a going concern or not. If it is a going concern, that means that the director is saying that the company will survive, will carry on in the next 12 months. If the director says that it is not a going concern, it means that there are good chances, not sure, there are good chances that the company might close down in the next 12 months, right? Director should also present a balanced and understandable assessment of the company's position and prospects through the annual reports, balance sheet, etc. So they have to give honest records in the financial statements, not do any errors and frauds. And if any error or fraud is found out, it is the responsibility of the director. They may be involved in it, they may not be involved in it, but the ultimate responsibility lies with the director itself. The director should also explain the basis on which the company generates or preserves value and the strategy for delivering the long-term objectives. That is, what are the plans for the next 5 years? How is the company going to generate revenue and profit in the next 5 years? This strategy also the directors have to announce. Companies over a certain limit are subject to an annual audit of the financial statements. This audit is an independent examination of the accounts to ensure that the legal requirements are met. Note that the auditors are not responsible for preparing the financial statements. What are the auditors exactly? For certain companies, as I told you, if they have their revenue and profit above a certain level, they need to involve a third party who is generally a chartered accountant or an ACCA, and they ask this third party that we have made the balance sheet and P&L, but please check our balance sheet and P&L. Please check our financial statements to make sure that they are free from errors and frauds. This third party is not connected with the business in any way, but they are experts in finance, experts in accounts, they are CAs, ACCAs, etc. So they are going to thoroughly check the financial statements and decide whether there are any frauds or errors on it. Please understand that these are called as auditors. Auditors are not going to make the balance sheet and P&L. The company is going to make the balance sheet and P&L. The auditors are going to simply check the balance sheet and P&L and see if there are any errors or frauds in it. The findings of audit are to be shared directly with the shareholders, not with the directors of the company. The audit gives the shareholders assurance that the accounts give a faithful representation, fairly present the financial statement. In other words, the auditors will tell if the company has any errors or frauds in the financial statements, or if they give the financial statements honestly, truthfully, without any error or frauds. An audit therefore goes some way in helping the shareholders understand how well management has carried the responsibility and held up the company. If there are no errors or frauds as told by the auditors, that means the directors have done a good job in managing the company, because Having no errors and frauds is ultimately the responsibility of the directors. But if there are any errors or frauds found out, even if the directors are involved in it or they are not, the ultimate responsibility lies with the directors. That means that the shareholders would think that the directors have not done their job very well. They have not been able to avoid this error and fraud, right? I hope you're clear with this. This concludes with the complete understanding of chapter number 1, which is the introduction to accounting. We have covered most of the activities. One more activity, true or false, that I'm going to encourage you to do on your own. There is an activity 5 which we are going to discuss here. Which of the following sources of information would be most useful to managers to use when making decisions at the year end, correct? So at the year end, for the year ahead, they will be relying on the financial statements for the year before so that they can make their budgets, their estimates for the upcoming period, right? This concludes chapter number 1. We'll shortly start with chapter number 2. I hope you have understood everything, and we'll start with chapter number 2 shortly. Welcome back. Let's begin with the second chapter of F3 or FA, which is the regulatory framework. What is exactly the regulatory framework and what are we going to study in this chapter? We're going to study a little bit about IFRS and how IFRS are made. But before we go into how IFRS are made, let me tell you a little about what are IFRS. IFRS stand for International Financial Reporting Standards. In India, IFRS are adopted by different name. They are called as IAS, that is Indian Accounting Standards. So why are IFRS not implemented in India, and what is exactly IAS? Let me give you a simple example. Now if any one of you has been to China ever, you will understand that the food there, Chinese food there, noodles, Manchurian, are quite bland. They're quite not spicy. So in India, when we eat Chinese food, it is full of spices, it is tasty, it is definitely not bland. So is it not Chinese? It is definitely Chinese, but it is adopted. It is changed slightly to meet the Indian taste, Indian requirement. Exactly same like that, India has also adopted the IFRS, but it has not adopted the IFRS as they are, but has made the version of it which is best suited for the Indian requirements, which we call as the Indian Accounting Standards. So what are IFRS exactly? IFRS are a set of rules, principles, basically on telling companies how to make their financial statements, how to record the revenue, what amount to record the revenue, how to show the non-current assets, the current assets, everything in the financial statements. So obviously the question is that who makes these IFRS? That we are going to see in this chapter. But why IFRS? The answer is very simple. Now, if let's say that every company decides, last time I told you a concept called as depreciation. So what is depreciation exactly? Let's say, to recap your memory, let's say you buy a vehicle in the year 2018 for 70,000. Today, after you use it for 4 to 5 years, do you think the value will be 70,000? Definitely not. The vehicle is not in as a good condition as you purchased it, not that good a mileage performance. So therefore, the value is now dropped from 70,000. This reduction in value every year is what we call as depreciation. So if companies had no IFRS, every company would have applied its own method of depreciation, own rate of depreciation, and there would be a lot of different opinions and interpretations on how to make the financial statements, and each one would be right because there is no uniform policy. Because of that, it would be impossible to compare one company against another, to compare Maruti and Tata Motors, and thus investors would be in a difficult position to decide which company is performing better, because all of them have made their financial statements in a different way. Also, the company might change the way it makes its financial statements every year, might change the method. Hence, it would be very difficult to compare the financial statements of the same company of last year as against this year. To avoid this confusion, it is very necessary to have a uniform method of making the financial statements so that you can compare the company's own performance against the last year as well as the company's performance against its competitors. This uniform method on how to prepare the financial statements is given through International Financial Reporting Standards, also known as IFRS. So this addresses the question as to why IFRS are important. Now, who makes IFRS? How do companies adopt it? What if there is some confusion in IFRS? Who solves it? Let's see one by one. Okay. So first of all, who makes accounting standards? Who has the power to make the accounting standards? First is the national or the local legislation. In most countries, limited liability companies are required by law to publish and prepare accounts. The form and content is given by the national legislation. Previously, we had accounting standards which were decided by ICAI, Indian Institute of Chartered Accountants. Thus, also in Indian accounting standards, as I explained before, how to adopt these IFRS to the Indian requirements is decided by the Indian laws, national legislation. Now, accounting concepts and individual judgment. Many figures in the financial statements are a basis of judgment. Okay, now this can lead to subjectivity. As I said, everybody can have a different judgment. Working from the same data, different groups of people could produce different financial statements. Now, if we leave all the items in the balance sheet and P&L to judgment, it will be impossible to compare the financial statements with other companies, and therefore this will be all the more significant where it deliberately happens, okay, to manipulate the accounts. So therefore, it is okay to have few items for judgment. Which are the items for judgment? We will see in the future chapters. But for most of the items, we need to have uniform policies. Otherwise, it will be impossible to compare the financial statements of one company to another. I hope you are following so far. Yeah. To this end, we have to develop the IFRS in order to reduce the subjectivity and to ensure that the financial statements can be compared. Now, these accounting standards can be developed both at national level as well as international level. It's not mandatory for all countries to adopt IFRS, although most companies have, but you can do three things actually. You can have your own accounting standards, which India previously did. You can have a modified version of accounting standards, which India is currently doing, which we call as the Indian Accounting Standards, IAS. Or third option, you can adopt the IFRS as they are without any change. In FA syllabus, we will be studying the IFRS, okay, not the IAS, not the previous accounting standards in India, but the IFRS, because you are going for an international degree. So, the first body to understand in this IFRS universe is the IFRS Foundation. Who is the IFRS Foundation? This is a non-profit public interest organization set to develop high quality, easily understandable, globally acceptable accounting standards, and to make sure more and more countries adopt accounting standards, not compulsorily IFRS, but accounting standards, in order to reduce the confusion, in order to encourage uniform financial statements. So three things. What does the IFRS Foundation focus on? To develop high quality, easily understandable, and not specifically to any market, US market, UK market, but globally applicable accounting standards, and to encourage more and more companies to follow accounting standards. I repeat, not just IFRS, but accounting standards. They may develop the accounting standards for their own country, but accounting standards to avoid confusion and to encourage uniformity. Okay, that is the focus on IFRS foundation. So to encourage more countries to use accounting standards and to develop such accounting standards that are easily understandable, of very good quality, and which work globally. Now, in this IFRS foundation, who exactly makes these IFRS? Who exactly does the work of drafting, writing and finalizing these IFRS? This is the work of the IFRS foundation. Okay. Now, what does the IFRS foundation do? As I told you, to develop a set of high quality, excellent quality, easily understandable and globally working standards which can globally work, financial reporting standards, easily understandable, globally working and high quality standards. The IFRS foundation is responsible to develop, to draft, to write and then to finalize. These standards should require very high quality, very transparent, but most importantly, why we are doing this? Comparable information. Okay, so that you can compare the information of one competitor against another, right? Why is it so? To help investors, to help other stakeholders make their decisions, correct? So as I said, investors are confused whether to invest in Tata Motors or Maruti. If both of them implement IFRS, their financial statements can be compared, and thus the investors can compare it and then take a decision of whether to invest in Tata Motors or to invest in Maruti, correct? So therefore, as I explained, high quality IFRS foundation has the responsibility of writing, drafting, finalizing excellent quality, easily understandable, globally applicable financial standards to help the investors and other stakeholders compare information and take decisions. To promote the application of these standards, not just develop them, but make sure that more and more companies implement it to inform uniformity. Okay. Now, very important, these standards have to be developed not just looking into consideration the best companies, the top companies like Infosys and Tata, but to understand the companies at all levels of all sizes, small, medium scale, all the sizes. Okay, and to promote the adoption of IFRS through the convergence of national accounting standards and IFRS. Now, as I told you that countries have their own independence to develop IFRS. But let's imagine that Netherlands has its own set of accounting standards and an Indian company is dealing with Netherlands. Now India follows IS, Netherlands has its own accounting standards. It will be difficult to compare the financial statements of both countries. Hence, ultimately, if all the companies across the world adopt IFRS, it will be easily possible to compare any company in anywhere in the world with another company all across the world. Okay, so therefore the best case scenario is if all the companies ultimately adopt to IFRS, correct? So the IFRS foundation has a couple of responsibilities: develop standards, make sure how to develop standards, quality, etc. already discussed. Make sure that the standards are used and reach the maximum people, and try to involve more and more countries to ultimately adopt IFRS itself, so that companies from any country can be compared to financial performance of companies from any other part of the world. Making sense? This is the responsibility of the IFRS foundation. Now, the next committee is the IASB, which is the Accounting Standards Board, the International Accounting Standards Board, right? Now, this is also the body which is responsible for developing the IFRS. This is the body which is also responsible for developing the IFRS. Its main objective is to bring about harmonization of accounting standards. Okay, so what do we mean by this? To bring harmonization, commonality between the accounting standards adopted by different countries and IFRS, so that ultimately all the companies come at par equal to the IFRS policies. Okay, it is an independent, privately funded body. Prior to 2003, standards were issued by IAS. Now they are issued by this board, IASB. Obviously, in order to make this globally accepted, the board members come from all across the world, different countries, different academics, different fields, in order to make it globally acceptable. So, as I said, the ultimate responsibility of preparing the IFRS lies with the IASB. Okay, the IFRS foundation, as we studied above, is going to check whether, okay, the standard is prepared. Now, is it of high quality? Is it understandable? Is it globally applicable? How to involve more and more countries to adopt it? This is all checked by IFRS foundation. But the main responsibility of writing, drafting, earlier we discussed it is with the foundation. That's not exactly correct. The main responsibility of writing, drafting, finalizing lies with the IASB. The foundation is going to check whether it is of great quality, globally accepted, understandable, but the main job of writing it, finalizing it, is by the IASB, right? The next up is the interpretation committee. Now, this committee's job is as important as any other. Once the IFRS is developed, now let's say that we have a new law, we have the GST law in India, we have upcoming laws in India, bills in India. It's obvious that it could have some loopholes or some mistakes or some gray areas, some confusing areas, some policies which could be in conflict with other laws. Same could happen in IFRS. All of this is handled by the interpretation committee. So what exactly does the interpretation committee do? It issues guidance on both how to apply the existing IFRS and how to account for new financial reporting issues where no IFRS exists. Two things. If the companies are confused with existing IFRS, how to implement this, what exactly is the meaning of this, that is helped by the interpretation committee. Similarly, there are some areas where there is no IFRS. Example, the application of AI in business or machine learning in business or cryptocurrency. There is no IFRS in it. So what do companies do? How do they prepare the accounts in these areas where there is no IFRS? That is also held by the interpretation committee, right? The members provide the best possible technical advice, technical expertise and diversity of international business. These are members which have the best possible knowledge, best possible business experience, right? Interpretation committee is going to do two things. To review on a timely basis newly identified reporting issues not addressed in the IFRS. As I said, the interpretation committee is going to tell the IASB who writes the accounting standards. They're going to tell the IASB, hey, you prepare the IFRS, we know. In areas of cryptocurrency, there is no IFRS. So please make an IFRS there. This will be told by the interpretation committee to the IASB, correct? To clarify issues where conflicting interpretations are there or where a guidance is required. So as I said, an IFRS is already there. The IASB has issued an IFRS, but it is confusing. The terms are confusing, or one IFRS saying something, this IFRS is saying something else. In this case, the interpretation committee will help you to get clarity where there is any confusion or where companies need some guidance. Okay, I hope we are okay with this. Yeah. Now the advisory council. The IFRS advisory council is essentially a forum used by the IASB. Again, what is the IASB? It is responsible for writing, drafting, finalizing the accounting standards, the IFRS. So the IASB is going to consult with the outside world. It consists of academicians, user groups, other people, okay, and giving practical advice on the implementation of standards. The advisory council meets the ISB at least 3 times a year and puts forward the views to the current standard setting projects. What do you mean by this? Now the accounting standards are set by the ISB and then released into the world by the IFRS Foundation. So what is exactly the public opinion on this IFRS? Does the public find it user friendly? Does the public encounter any issues on it? What is their overall interpretations? Is it a high quality accounting standard? Are there any loopholes in it? All of this information is gathered by the advisory council and passed on back to the ISB. This helps the ISB to improve on its mistakes when forming new accounting standards, when they form new IFRS. Clear? Now, the scope and application of IFRS. Now, what is the scope and what is the application of these IFRS? Any limitation of the applicability of IFRS is made clear within the standard. What does it mean? That this IFRS is applicable to these areas, this IFRS excludes these areas. This is specifically mentioned in the IFRS. Second thing is, IFRS are not intended to be applied to immaterial items, nor are they retrospective. This is very important. For example, you have started applying these IFRS from the year 1890. You do not have to revise the accounts of 17, 18 and the years before. Now from 1819, you will apply these IFRS going ahead, correct? Each individual standard lay out its scope at the beginning, that is what all it's going to cover. Application. Within each individual country, govern to a greater or lesser degree the issue of financial statements, that is how to make financial statements is the main objective of the IFRS. These local regulations include accounting standards by the national bodies or professional bodies. So as I said, companies have an option of direct implementation of IFRS or a modified version like India does, or has its own accounting standards. That is also okay. So you can refer to the diagram in your textbook. As you can see that the IFRS Foundation, the Council, the ISB and the IFRIC, right? Now the IFRS Foundation is going to assign the interpretation committee to help people with the existing standards and to give advices where new standards are necessary. The advisory council is of course going to advise the ISB on what does the public think of the accounting standards. And once the accounting standards are developed, the ISB is going to report to the foundation. The foundation is going to check whether the standard developed is of good quality, understandable, globally accepted, etc. But the main preparation of accounting standards lies with the IASB. Perfect? Now, what all do IFRS actually do? Let's take an example of an inventory assignment. You have contacted your supplier and you have purchased 10,000 kgs of raw material with a total value of 60,000, correct? You have purchased it on 29th of March. As you know, the financial year end is on 31st of March. Okay, so first of all, you have purchased some raw material with 10,000 units at 60,000, correct? You have purchased it on 29th of March and you're going to get it on 5th of April. Let's write down the scenario. Okay. Purchased on 29th March and received on 5th of April. Now in 60,000 the supplier has given you, let's say, discount of 10%. So you're going to get it at 6,000 less. So you're going to get it at 54,000. What does exactly IFRS help you in? First of all, when is this to be recognized and where? Do you recognize it on 5th of April or do you recognize it on 29th of March? If you recognize on 29th of March, it will be in this year. If you recognize on 5th of April, it will be next year. This question is solved by IFRS. Secondly, measured at what amount? Measured at 60,000 measured at 54,000. If you measure at 54,000, do you do anything about the 6,000? Where do you show the 6,000? Given by the answer given by the IFRS. Presented under which heading? As I said, if you purchase an asset, is it a current asset? Is it a non-current asset? All the information given by IFRS. And last is disclosed. What information should be disclosed by notes to accounts? If you're not aware by notes to accounts, these are notes which give further information, further explanation about the financial statements. So how much information should you disclose in the IFRS? What to include, what not to include is given by the IFRS. So measurement, recognition, presentation, disclosure, all of the answers are given by the IFRS. Okay, so with this we conclude the understanding of why IFRS are made, how IFRS are made, who uses these IFRS, and who interprets these IFRS, etc. I'm going to take up a few of the questions from your textbook. First question: what is the role of the IFRS Foundation? What is the role of the IFRS Foundation? I need you to read it for a minute and then I'll tell you the answer. So the role of the IFRS Foundation is to appoint the members of the IASB. The actual development of accounting standards is done by the IASB, but these members have to come from all over the countries, all over the world, all walks of life, all finance, accounting, law, etc. Why? Because we want to make them globally accepted. These members are chosen by the IFRS Foundation, which we saw as the first slide, right? So these members are chosen by the IFRS Foundation. Second, accounting standards are issued by, accounting standards are prepared and also issued by the IASB, International Accounting Standards Board. Okay. Third, which of the following is the best describes the role of the Interpretation Committee? International Financial Reporting Interpretation Committee. You read for 1 minute, then we'll discuss the answer. So the role of the Interpretation Committee is to interpret the IFRS. Where there are existing IFRS, to help clarity if somebody is confused or not clear. Where there are no IFRS, to tell the IASB that people need a new IFRS in this area, to inform the IASB. This is the role of the Interpretation Committee, correct? Last question: are the following statements true or false? IFRS need to be applied to achieve fair presentation of financial statements. What do you think? This is true. They are primarily designed for non-for-profit organizations. False. They are for all kinds of organizations. They are designed to apply to general purpose financial statements. This is true. General purpose as in balance sheet, profit and loss, cash flow, all of them. General purpose, regular financial statements. And they set out recognition, measurement, presentation and disclosure requirements of transactions and events. This is absolutely correct. We just saw recognition, measurement, presentation and disclosure. In this way, we have concluded the second chapter, regulatory framework. Let me give you a quick recap of each of these. First, the IFRS Foundation. They're going to make sure that the standards which are developed by the IASB are of good quality, easily understandable, globally accepted, and this body is going to promote maximum people to use and adopt IFRS. This is the role of the IFRS Foundation. Next is the IASB, of course, to develop and to give the public issue new IFRS. Role of IASB. Interpretation committee, where there are existing IFRS but they may be confusing, this committee will help you out. If there are no IFRS and the public needs IFRS in these areas, they will inform the IASB that please make new IFRS in these areas. Advisory council. Once the IFRS has been issued by the IASB, what does the public think of it? What are its strengths, weaknesses? Is it of good quality? Is it understandable? The public opinion is taken by the advisory council and passed it back to the IASB so that they can improve when they issue the new standards. Scope application. The role is for recognition, measurement, presentation, disclosure. We have just taken the example of inventory to see it, and then we saw the activities. I hope everybody is clear with this IFRS. We are going to see a bunch of IFRS in the coming chapters, and we'll start from our main discussion in the third chapter very soon. Thank you. We conclude with the second chapter, and we have so far studied the introduction to accounting and the regulatory framework. Thank you.